Welcome to the 3 Edge Week in Review for the week of September 30th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will discuss what we describe as a tale of two equity asset classes, two markets that for most of 2024 behaved quite differently, that is until recently. So we'll take a look at what has happened, particularly when it comes to monetary policy, and see if perhaps we could learn anything that might help us to navigate our way forward here in the fourth quarter of 2024 and beyond. Before we get to that, as we begin the fourth quarter, there seems to be a lot going on in the world that could impact the global capital markets, including the ongoing conflict in the Middle East, which seems to be getting dangerously close to becoming an actual war between Israel and Iran. And of course, continuing escalation of that conflict could threaten to disrupt the world's oil supply, send the price of oil much higher. And we already have seen crude oil begin to climb here in early October. Thankfully, for now anyway, the striking dock workers on the East and Gulf Coast have returned to their jobs, sparing all of us yet another round of painful and expensive supply chain disruptions. And of course, we're in the final month before the U.S. presidential election, the outcome of which remains decidedly uncertain. So, Steve, for much of this year, and in fact, really over a multi-year period now, U.S. equity indices such as the S&P really outperformed ex-U.S. equities, and in particular, emerging market ex-U.S. equities. They've just struggled to keep up with the S&P as it continued to make new highs. So perhaps just to get us started, could you explain why we've experienced the equity markets here in the U.S. so dramatically outperforming all the other ex-U.S. markets?
Well, after the financial crisis of 2008, there was massive stimulus supplied by both the U.S. and other central banks like China and Europe, et cetera. And all the equity markets responded favorably and rebounded strongly after that. Then about 2011, that's when the big departure that you mentioned, Fritz, happened, where the U.S. stocks continued to outperform to a great degree. And in particular, emerging market stocks underperformed. And this has been going on for more than a decade. And part of this is because U.S. stocks first started to outperform because their earnings of their companies were better, growing more strongly. But then investors continue to put money into the U.S. market relative to, say, emerging markets or other underperforming markets, simply because it was doing better. They were following the trend that was attracting more money. And frankly, over the last decade, the price per share of the U.S. stock market index grew much more rapidly than the underlying earnings or sales. So it was a self-reinforcing feedback loop, and people ignored valuation and just bought because it was going up, and that caused it to go up more, and they bought more. It was just a long ride. Whereas with emerging markets, the exact opposite happened. They underperformed, so people bought less or they sold more. And that continued to make them underperform even more. And as of recently, over a decade of this has meant that U.S. stocks are relatively so overvalued compared to emerging market stocks, which are so undervalued. They're like two mirror images going in opposite directions.
All right. So now, beginning in mid-September, really, we have seen emerging market equities have actually begin to outperform the S&P. So perhaps you could get into this a little bit and explain why we're starting to see this happen.
Well, there are two events that happened just recently that caused this major change in direction. One is U.S. Federal Reserve Board came out with the half of a point or 50 basis point rate cut. And all else being equal, one thing we know is that when the Fed eases financial conditions, it's especially good for emerging markets who have a lot of their debt tied up in U.S. dollar terms. And when the Fed eases, the dollar generally gets more relaxed. Emerging markets can breathe easier, and it's generally good news. But the other event that happened that even had a more direct impact was that after months and months of not doing anything, China came out with some massive new stimulus programs, lowered interest rates, lowered reserve requirements for banks, made it easier to buy real estate, reduced regulations, and so a combination of both monetary and fiscal stimulus was a big catalyst. And so here you had a market, you had emerging markets, and China is a good example, just getting more and more depressed, more and more oversold, more and more undervalued. The catalyst comes along, and then boom, there's this huge abrupt shift upward because now people realize, oh, well, maybe we should look at valuation.
All right. So this is really interesting, actually. So my final question is, so we're starting to see perhaps this shift with emerging markets starting to perform better and maybe even outperform the U.S., at least over the last month. So what changes, if any, or how should investors think about potentially repositioning their portfolios at this point?
Well, for so long, many have argued that emerging markets are undervalued and people should consider investing. And that proved to be a bad strategy because when they did, emerging markets kept underperforming even more. And so one should consider, well, possibly this is the catalyst everyone's been waiting for. They're so undervalued that perhaps there's limited downside risk and some potential longer-term upside. It's still unclear whether all these stimulus activities are going to help the underlying economies in the emerging markets in China. So this could be a move that really helps the markets for a few months because they've been so undervalued and people are now thinking of them differently. But it may or may not be great for the longer term. But at least in the shorter term to intermediate term, people might consider an allocation to emerging markets at this time. But there's another lesson here that I do want to say while we're talking about this topic. You talked about the tale of two markets, and they're almost like mirror images of another. We had a U.S. market that kept making new records and kept outperforming, but kept getting more and more overvalued in the process. You had emerging markets, in China as an example, that kept underperforming, that kept getting more and more undervalued at the process. And now we see the power of a catalyst coming along and changing direction when a market valuation is so extreme. So we have to think, well, is there a lesson there? So we have to be careful about the U.S. market that's outperformed so much but is now so overvalued. We have to worry that if and when a catalyst does come along, the potential for an adjustment back to fair value is really high, and it could be quite a ride down. And just seeing how quickly the emerging markets recovered in such a short time when the catalyst appeared should remind us that, well, that could happen quickly on the downside for an overvalued market. So that's just one point I really wanted to make today.
That is so interesting. This idea that that what happened in China, particularly that spike in earnings, I think the Chinese market was up maybe 15% over the course of 1 week or something.
Short time.
And maybe that's a cautionary tale when we look here in the U.S. Very interesting. So thank you. All right, great. Thank you. So that will do it for Steve and me for this week. Eric Beagleisen, our Director of Investment Research and Deputy Chief Investment Officer, and I will be back next week to do our 3-Edge View from the Edge for October. As a reminder, all our videos are always available on our 3-Edge YouTube channel. If you know someone who might benefit, who might enjoy these videos, please feel free to share them. In addition, if you enjoy our weekly videos, please consider subscribing to our 3-Edge YouTube channel. We would be most appreciative. So, until next time, on behalf of Steve and everyone here at 3-Edge, thanks for listening.